Hello, welcome to another episode of the Legacy Investing Podcast. I'm Nate, and I'm joined, as I always am, by my good friend Josh. How you doing, mate?
I'm awesome, man. How are you?
I am perfect. What's going on?
Just smashing some food while we do our podcast.
Yeah, so professional.
So professional. Well,
What
it's
are you
8 o'clock.
eating? What do you got for dinner?
It looks like bacon and eggs with hollandaise sauce and also some fried kale.
Sounds delightful.
Mixing the health with the delicious.
Yeah, perfect. Hi, mate. How's things been going? Have you been following what's going on in the markets? I know you love it. You keep a close watch on things, and
Yeah. From all I can see, everything's red. Everything's red. Today
yeah,
wasn't too bad. Today's what, the 19th? So Monday the 19th. We're filming on a Monday this time. But yeah, no, everything's fairly red still. Last week was a bit of a shocker in the US. What was last week? What was the big news last week again? It was inflation. Yeah.
yeah. So they had the inflation print was a little bit worse than expected. With the data that had come out for August, and so I guess the share markets tanked a little bit on the back of that news. It was the worst day since I think the COVID.
Yeah, June 2020.
The sell off, and I think we've had the worst week for some time as well. So there's a good train of thought as a lot of people sort of starting to speak up a bit. And you get all the bears come out and they start getting a bit louder, don't they, at these times? But it's worthwhile listening and just, I guess, arming yourself with some knowledge there. Are we going to retest those lows that we had back in June or July? I think it was. We're getting close. Just looking at the futures for tonight in America, it looks all down, sort of around about 1%. So the important stuff coming out this week in America to look at would be the obviously Jerome Powell will be speaking, and we find out what they're going to do with interest rate rise. I guess consensus is that it'll be 75 basis points. A few people are starting to talk about maybe a whole percent, but yeah, definitely some big news. And the other big news last week, mate, was the FedEx report. So FedEx talked about a global recession. They'd seen massive slowdown in their, I guess, deliveries and what was happening around the world. Doing some job layoffs and shutting down some planes just due to a gross lessening of demand, I guess. And so that freaked the market out a little bit on, I think it was Friday last week. And it carried over into the Australian market on Friday. And today, I think the Australian market was down just a little bit, but
like 0.2%.
Yeah, big week I think on the market.
Yeah,
in the next couple of weeks.
A lot of people are talking about it dropping and it being a big one, right? Like we've seen roughly like 30% on the Nasdaq and what 20% year to date on the S&P 500. I don't know about the Australian market. I should probably know more about the Australian market, but that's your realm at the moment.
Yeah, I actually not sure. It was getting pretty close to 20%. It did pop in this sort of last little rally. I don't know exact numbers though.
Yeah. No, so yeah, it's interesting times, and we've talked about Michael Burry a lot in the past, and he says he feels that pre 2000 tech bubble, the pre 2008, he feels like that's happening again. Is it Jeremy Grantham?
Yeah, big bear. Yeah, he's a mega bear. Loves to call it.
Yeah, he's going to be like a 1929-30 period, the 70s period, 2000 period again. So he's very bearish, and he's very loud about that as well. So you mentioned Robert Kiyosaki earlier. I think he's fairly bearish all the time. So
yeah, he loves a big bear. He's buy Bitcoin, gold, and silver. He's promoting at the moment. So
whatever happens. Like we were just talking about our portfolios, and even whether it's green or red, we still look at what it's going to look like in 10 years, right? And you mentioned Buffett buys on the way down on these investments that he wants to load up in. He doesn't care if it's red 50% down for 3 years, because he knows in 10 years, 20 years, 30 years, it's going to make a lot of money. So, yeah, speaking of down, how's Google, mate? Down to $101.
Is that what it is? Google,
Yeah,
101.
free market, $101.50.
Yeah. Well, actually, I mean, this wasn't what we're going to talk about, but Google, I saw an interesting fact on Google that I think it's the whoever's after the millennials, Gen Zers, are, if you are wanting to find a restaurant, the number one search engine, or more and more people are starting to use TikTok and Instagram for searching of food and restaurants. And, Google, I think, is aware of this, and they've combated it with some sort of YouTube mini or whatever it is. I think they're trying to, but very interesting. I never would have thought. We think of Google having just, I guess, the biggest moat in terms of search, but what we're seeing is that video searching is getting much, much bigger on the TikToks and Instagram. So, watch that space, I reckon, to see what Google do to try and combat TikTok's drive at the moment. I hadn't never really thought about that, but it was an interesting fact when I saw it.
Yeah, I did not know that. Hey, but I guess that's one area, as we've talked about. We believe Google has the best search engine in the world. It's used by so many, but Google's diversification as well, right? Like they've got, like I said, YouTube. They've got their search engine. They've got Android. They've got a lot of stuff happening there. So and their cloud's growing nuts. We use Google Suite for our business, right? And here's one I didn't know. You can make a free website with Google, just completely free. You can build a page,
Google page. Yeah, Google site, it's called.
Yeah. So shameless plug here. Sarah and I are changing our business name to Doggo Days, which is an online platform for booking pet sitters and so forth. But as we're changing all of the back end over with our team of developers, we're creating a landing page using Google, and completely free. And it's just this is amazing. So, yeah.
Is that just a Google site?
Yeah. So Google site's basically a landing page with register your interests. Still still building it. We've got to put a video and so a bit more information on there, but just embed a little form where people can put all their details. It's really awesome.
And that it links okay with your website?
It will. So eventually we're going to actual websites on AWS. So, a bit of conflicting here. But what we'll eventually do is just merge the domain name straight across to our main website.
Yeah.
Probably have our old domain name, which is Canine Calm Walks, and then have that as a forward to the new website. So
good stuff. Well, mate, let's get into it. We're going to do a bit of a how-to tonight. You're going to lead the way. You're going to share your screen, so look out for this one on YouTube as well. And you're going to do a little bit of how-to on some options trades or options trading that you've been doing. You've been able to beat the index this year so far using a few of these strategies. This is really not my area at all. I know minimal about this, so you're the man. Take it away, mate. What are we going to look at?
Yeah, so like you were saying, essentially, you've been interested in learning this as well. I've been learning it for a few years now and been practicing it more so recently. Personally successful in my portfolio, which I'm pretty happy with. And just trying to put our legacy spin on this. And we've talked about options in the past with regards to, selling put contracts and selling call contracts on selling puts on companies we want to own for a price we want to own, and selling to sell a company just to create a cash flow while we own the shares, right? But yeah, I've been adventuring a little bit more into, I wouldn't call this isn't investing, and I don't want to say it's investing. It is I would call it a level of gambling, right? It's just legal gambling on the markets, in my opinion. But you can kind of use it to your advantage if you're doing things that you want to do, in terms of owning companies and so forth. But yeah, essentially we're gonna switch across to screen sharing, but I'll also still try and explain it as best as I can for anybody who's only listening on the podcast. And then another shameless plug. So my YouTube channel, I'm currently changing it across to our branded. So it'll be Legacy Investing. It'll be a YouTube channel, Legacy Investing. I'm sure I'll put the link in the notes or something like that. Never done that before.
Get it in there.
Yeah, but essentially, currently, I think it's still called Fundamental Finance and Investing, and it will be called Legacy Investing. So let's get
awesome.
Right.
Mate, one of the key points while you just get that up there, you were saying is that you're not just willy-nilly doing options on random companies. You know these companies, you understand them, you know the management, you know their numbers, and yeah, you're using the options to your advantage. You're happy to own these shares anyway. So in some ways, there's a little bit less risk for you. You're not sort of going to end up with owning some shares of a company that you just know nothing about and don't really want to own. So yeah, you understand these things that you are these companies you're buying.
Yep, 100%. So because this is going to be a little bit hit and miss at the moment, but because so for anybody watching now, the market in America is not open at the moment. It doesn't have the bid and ask spread, but I do use model here, and what model is what essentially the brokerage account thinks that option will sell for. So in terms of this, what I'm currently looking at is a $90 strike price. They think that the in the current market conditions, the strike price will sell for $17.35 per contract. So
for those who are listening, we're in Josh's Interactive Brokers account here, and we're looking at his sort of options. What company are we looking at here, mate? Barber.
This is Barber.
Barber.
I'll go across to, so I've got 9988 open here as well. And here you go. This is what it more looks like, right? So this is Alibaba on the Hong Kong Stock Exchange. And I'll go through what the parameters are as well and try and explain them as best as I can. So in this instance, looking at, say, the $90 strike price again, you've got the spread, the bid-ask spread, the model, which is what they think it'll sell for at this current time. I'm just going to try and move this on the screen as well. But a few things to note. So across the top here, a few things you want to be always cognizant of. This is the expiry dates. So options have different expiry dates depending on how many contracts or how high volume a company has on their options chains. They can do weekly dates. These ones in the Hong Kong exchange only do monthly dates, and you can go as early from this point as September. We're in September now, so you can sell contracts in September, and the cost will generally be less, because the longer there is to the expiry date, generally there's a higher price on the contract, and then as the time gets closer to the expiry date, the price starts to essentially you lose a bit of that price. Essentially,
so more valuable for a longer contract, and less valuable for short contract.
Yeah, essentially it loses its value. Another thing I always look at is IV, which is implied volatility. And essentially, if a company has been moving like crazy, like volatile, its implied volatility will be a higher number. And then because it's so volatile, the contracts will cost more because there's so much movement, people are taking on more risk. But yeah, I'll essentially go through a few different scenarios of what I do in terms of my contracts and so forth. If I'm looking to buy a company, but I want to do it via selling put options, I usually work on roughly a 30 to 45 day basis. That's just kind of that sweet spot where the as you get lower on the days, as it gets closer to the expiry date, the contract starts to become worthless, and you can potentially buy it back for a lot less than what you sold it for, and that turns into a realized gain. Or it expires, you're not in the money, and then that means that you just keep all of that premium that you made. But if the price drops below your strike price, that means you get put the shares. So it's a win-win, right? You make money, You either get given, you have to buy the shares, or you make money and you don't buy the shares. So just to discuss it a bit more, then say like currently, what's this? This is the 9988 shares, and currently they're at $83.70. So like I could sell, let's just say I wanted them for 80, I could sell a contract on the $80 on the put side. And if the price goes below $80 when the expiration day comes, then I will be put those shares. I have to buy the shares at $80, regardless of if they're 80 or regardless of if they're $3. I still have to buy them for $80. Because I'm taking on that risk, I will be paid by the person who buys the contract. So it's a contract between me and somebody else. Yeah, so that's basically how that works. And that's how you can make premium, like that's how you can make options premium or income, essentially, because it's cash at the end of the day. As soon as that contract gets sold, that cash goes straight into my account. So it's a way of making money on wanting to buy a company, especially if it gets down closer to those things, because it may sit at 83 for the next 6 months, and I just keep selling the contracts at 80, and I just keep keeping that money. And then when I get put the shares finally, my basis is way lower because I've now made money on the company before I've owned it. If that makes sense.
Question, so you wouldn't be able to be just putting a bunch on every day, because these contracts are for, you said roughly around a month and a half. You would have to make sure you've got the capital. Is that right? So that if you put the shares, you need to be able to buy them.
Yeah, exactly.
If you're in the money, you need to be able to buy them.
Yep.
You can't just have 100, options on the go, and that's where the risk is at.
That is a risk, yeah. So pretty much you're only putting yourself up for as much as you want.
Yeah.
And
so
yeah.
You don't have to give too much personal information here, but so would you maybe have one of these on the go at once, or do you juggle a couple?
So recently I've been getting a bit more adventurous, and like I said, this is, this strategy here is pure legacy investing style strategy, right? I want these shares, and I'm only selling as many contracts as I want to own shares. We're going to get to another strategy in a moment, which I think is much more valuable whilst being much more risky. And this is going to sound weird. It's much more risky, but it's a lower risk in a way. I'll explain it. It's a little bit difficult to explain without showing you. But yeah, for this legacy investing style, selling put contracts, I would only sell as many contracts for the shares that I want to own in my portfolio. In America, all of the contracts are, one contract is 100 shares. So, the bid, just to, use this one here, and this is an American company. This is Alibaba on the China Stock Exchange, the Hong Kong Stock Exchange, but I'll talk about it as if it is the American exchange. If I was to sell this strike price, so this is $80. If I was to sell this, and I use the model here, I would make $3.99 per share. Because it's 100 shares per contract, I would make $399 because you multiply it by 100. But then I'm also putting myself up for $8,000 because it's an $80 per share price times 100.
Yeah. So the $399 was the premium.
Yep. $399.
That's what you're paid for.
Instantly, that cash goes into my account.
Yeah.
And essentially, I can look at my basis in the company then. So let's just, for easy, round up $3.99 to $4. My basis, if I got put those shares, is only 76.
76. Yeah.
In the Hong Kong Stock Exchange, it's not 100 contracts. It changes depending on the company. And Alibaba in the Hong Kong Stock Exchange, there's 500 shares per contract. And obviously all this is in Hong Kong dollars. So
yeah. Has that got you in trouble before, mate?
Yeah, it did. It did. Like I do your research, always do your own research, right? So I didn't do my research, and I didn't get put shares, but I made 5 times as much money as what thought I was going to make. Luckily, I didn't get put the shares. So like, there's a few good things about this, and I'll talk about it once we go to the long contracts. But this is the exact same in this world, right? If the price, so let's just say I sold this contract at $3.99. If the company price goes up, this contract will become less valuable. So let's just say, there's $2.50 between these strike prices here, so $77.50 to $80. If the company goes up $2.50, I would expect this to roughly cost $3.11 because that's the price difference between
different.
Yeah. So then I could technically buy the contract back for a gain of 88 cents because it's $3.11 that I'm buying it back for, but I sold it for $3.99. So I'd make 88 cents per share. Or if this was like an American dollars with a 100 share contract, I would make $88. And that's then everything's closed out, and that's just money sitting in your account, and that's a win. So
yeah, so it's cancelling each other out. So you're not actually going to end up with any shares. You're not going to have to buy any shares there.
No,
and you can use that strategy, I guess, if the share price is bouncing around a bit.
Yep. So that's all I'll probably say on the put side of things.
Yeah.
On the call side of things, so using the legacy investing strategy again, let's just say I own shares in Alibaba right here, and let's just say I'm happy to sell them. So in this instance, let's say I'm happy to sell them at $100 a share. Then I would sell the call contract, and the exact same on the thing on the other side, I would get paid that money straight away. If the price didn't make it to 100, I keep that premium and it expires worthless. If the price goes over 100, then I've just committed to sell it at 100, whether it's $100 a share or whether it's $300 a share. I've just committed to 100. So that's the risk you're taking on, and that's somebody's paying you to take that risk because they might want them shares at $100 or something like that.
Okay.
Yeah,
mate, you've chosen a pretty bad podcast here to get dinner during.
I know, it's fine. I'll take it cold. It's all good.
You're doing all the talking.
That's good. Last thing I want to do is put this up video-wise, and here I'm just like chomping away.
Mate, let's you were talking about some long options.
Yeah.
What does that mean?
Cool. So for this one, let's go out as far as we can. In this instance, so what I've done here for people listening is I've changed the expiration date to September 28, 2023, which gives us 374 days. Now, as you can see, and just to explain it, all of the contracts cost heaps more. In the terms of like last one, I think it was like $3.99 or 80. This instance, it's $13.30 per contract. So in this instance, you can see the massive percentage like you would be making on top of this. So if I was to be put shares at an $80 strike price, my basis is only going to be $66.70. So, but you can do, these are called leap. I can't remember what it stands for. They're leaps. This would be classed as a leap put. But essentially I'm not doing this in a legacy investing style anymore. I'm doing this because I think, so it depends on if I'm doing buying or selling the puts. I highly don't recommend selling calls if you don't own the shares. That's what you call a naked call, and you can really, if things go wrong, you can lose a lot of money. So highly don't recommend that. But in the put side of the house, I would only do this really if it's a company that I still want to own at that price. But in this instance, I'm giving myself 374 days. And the whole reason that I like the leap side of things, like the long put, is because if I'm wrong, I have a lot of time to be right still. So as time goes on, the options price becomes less and less valuable. So that's one thing in my favor. As time goes on, it becomes less valuable. But if I'm betting that the stock price will go up and it goes down, but 3 months later it goes up, then I'm still right. If that makes sense.
Yeah.
So that's what I like about this long extended version. So if I was to do an example, let's just say, and one other thing I want to make clear too is if you sell a put and it's in the money at any stage, technically the person who bought the put can exercise a contract at any time. Now that's very rare that an options contract will be exercised before the expiry date, but it is possible. So that's another risk there that you have to be willing to take. So in this instance, let's say I sold a $90 put here and the model says it's going to be $18.76. That means for every contract, let's just assume 100 shares per contract, I would make $1,867. If the share price moved up, which is what I'm betting it will do, then let's just say it moved up $2.50. The price $2.50 down is $17.21. So that would mean that I would make $1.46 per contract. Per share, which means if I was right and it moved $2.50 up, I could buy that back for a gain of $146. So that's essentially, you're making more percentage gains on the risk you're taking over a longer period of time, and the risk is still there that in 374 days, if everything goes wrong, you have to buy those contracts. However, you're giving yourself time to be right, if that makes sense. And because it's selling the contract, as time goes on, the contract becomes less valuable, meaning that you're giving yourself more chance again to be right because it'll cost less to buy back. So, this one I have been doing recently, and I've been doing with a few more contracts. So I'm putting myself up for higher risk, which, like I said, I'm happy to take on that risk. But the thing is, like, let's say I did 10 contracts here. Technically, I'm putting myself up for, if I was to do 10 contracts, $90,000 in this instance. I'm not saying I'm doing this, but I'm just saying in this instance, if I did that, I'm putting myself up for potentially $90,000 worth of buying the company, but I'm still giving myself 374 days to be right. So in my opinion, that risk is still a massive risk right there, but you're giving yourself time to be right. Now, if I did 10 contracts, I'm now looking at getting paid $18,670. And then if the price moved that $2.50, or over 370 days, the price can move a lot more than that. But let's just say if that price moves $2.50, now I'm making $1,460 instead of $146, and you can just close it out as soon as you can.
So in this scenario, you're not looking at buying the shares. You're using the options, or you're ramping up your premiums, and you're looking at buying the contracts back.
Yep. Essentially, I'm looking at buying the contracts back, and I'm simply using this as a cash flow generation. But I'm using it as a cash flow generation with the ultimate risk of owning probably more of the company than I would like, if everything went wrong for 374 days. So more than So that's why I've kind of taken on this little different way of making a little bit of extra money. And it's just essentially, we were talking before this, it's supplementing the down market at the moment, really. If you can make as much as your unrealized gains are dropping, then technically you're flat when the market's down. So it's just a cash flow strategy. But yeah. And
good stuff, mate.
Yeah. Should we cut it away there? What do you reckon?
Yeah, let's do it. I reckon, because we're doing a visual one as well. We'll keep probably the listening side of the podcast a bit shorter, I reckon.
Yeah, for sure. No, good point. Good point. So hopefully I explained enough of that to a point. But I'll stop sharing screen now. Back to us. So that essentially is two, maybe three strategies if you count, like if you own shares and you're happy to sell the shares at a certain price of calls. But that's two strategies, and potentially moving yourself into a company by selling put contracts and hoping that you get put the shares. But as long as you're not getting put the shares, you're making the premium, you're making dollars. And then, yeah, the leaps, that's a little bit more risky whilst giving yourself more time to be right. And you get higher gains on that. So, yeah.
Awesome. Well, do your own research, go away and, research that. And just to reiterate, definitely not financial advice. And Josh has well done his research on these companies that he's been looking at recently, so he knows them very, very well. Yeah, thanks for that, mate. Thanks for your little share screen there of what's been happening, and nothing sort of too exact there, but just some good examples of what you could do. And certainly we look forward to chatting about that again, I reckon. A bit more options stuff. It's I need to do a lot more research on that.
Yeah, let's personally jump on a few more calls and go through it. So
yeah, it's good. Well, thank you to all the listeners and the viewers out there tonight. We appreciate you jumping on the call, and we hope that everyone has a good week this week. So we'll catch you then. Catch you, mate.